Investors ask the same questions in almost every single pitch meeting, and how you answer them will determine whether or not you get funded. So today, I'm going to show you exactly how to nail these questions. I've been a part of hundreds of capital raises as a startup lawyer, and I've also raised venture capital for my own startup company. So I've seen exactly how you should answer these questions. By the end of this video, you'll be able to walk into any pitch meeting and easily handle every question an investor throws at you. Let's get straight into it. The money questions. So the first question investors will ask is how much you're raising and how you plan to use those funds. This is the question that immediately tells the investor whether you've done your homework or not. The way to answer this well is to tie your raise amount to a specific milestone you need to hit before your next round. For example, we're raising $1 million to get to $2 million in ARR within the next 18 months. That tells the investor two things. First, you know where you need to be when it's time to raise again. And second, you've worked backwards from the target to figure out exactly how much capital you need right now. That's a very different answer from just throwing up a pie chart that says a third goes to marketing, a third goes to dev, and a third goes to operations. Experienced investors see right through that because it's too generic and it tells them you haven't thought about what stage you're in and what that stage actually requires. Knowing where every single dollar is going to be spent matters. And investors want to see that you're going to be disciplined with their money and that it's going toward things that are going to drive revenue growth, customer acquisition, and increase your ARR. And the follow-up that often comes right after is, what are your margins? This is the investor checking whether your business model actually makes financial sense at scale. In SaaS, for example, anything below 50% margins is a red flag because it suggests your platform costs are too high. On the other end, SaaS businesses can sometimes hit margins as high as 90%, which is one of the reasons investors love SaaS model. So you want to be able to clearly explain what your margins are, why they are, where they are, and how they're going to improve as you scale. Now, real quick, if you're getting ready to raise and you want to make sure you can confidently answer every one of these questions before you sit down with an investor, click the first link in the description and book a free consultation with me. We'll go through your specific situation and make sure you're fully prepared. But let's keep going. Why you? Why now? The next set of questions investors will ask is about timing and the founding team. The first is why this will work now, especially if others have failed before. The second is why are you the right person to make this work? And the third is what is your long-term vision? Starting with the timing question, this is the investor testing whether you understand why this opportunity exists right now. When they ask why now, they want to know what has changed in the market or the technology or in customer behavior that makes this the right moment for your product to exist. A strong answer connects your startup to a specific shift that's happening right now. So for AI businesses, for example, the why now response is that artificial intelligence has improved and developed to the point now where, for example, AI agents are able to handle tasks that in the past technology wasn't developed enough to handle. AI software outputs were unreliable, but now at the time of this video, AI has developed to the point where the outputs have become quite reliable. Not 100% reliable, but they've come a long way and will only continue to develop. Then, when they ask why you're the one to make this work, this is the investor evaluating the team. At the early stages, investors are betting on the people more than the product. Prior exits put you ahead of almost every other founder in the room because it tells the investor you've been through the entire life cycle and you know how to get from zero to exit. Relevant domain experience matters a lot here too. If you're building a healthcare tech platform and your co-founder ran operations at a hospital system for a decade, that's a massive credibility signal. And if you don't have exits or deep industry experience, your advisory board can help close that credibility issue. Get someone on your advisory board who has taken a company from zero to exit in a similar space. So when you answer this question, you want the investor to walk away feeling like you and your team are the most qualified people to execute on this opportunity. And when they ask about your long-term vision, this is the investor testing whether you actually know where this company is going. Investors need to believe that your company can get big enough to return their fund. So when you answer this, you want to show that you have a clear picture of where the company is going, and that's rooted in how the market actually works. These are considered strong vision statements. SpaceX, their vision statement is to enable humans to become a spacefaring civilization. LinkedIn, their vision statement is to create economic opportunity for every member of the global workforce. A weak vision statement is simply to say to be the best company or leader in our industry, or even worse, to drive value for our shareholders. Good vision statements are future forward looking, focus on the why, and are bold. Bad vision statements are generic, uninspiring, or too complicated. Market and competition. So investors are also going to ask about your competitive landscape. The first question will be, who are your competitors and how do you compare? The second is, how is your startup defensible? For the competitors question, this is the investor testing whether you actually understand the market you're operating in. The biggest mistake you can make here is telling an investor that you don't have any competitors or that you're the only ones doing this. Investors who are deep in certain sectors see everything, and they've probably already seen 3 other companies building something similar. So if you claim there's no competition, you either haven't done your homework or you're not being honest, and honestly, neither of those is a good look. The way to answer this well is to show that you understand who else is out there and you can clearly explain what makes you different. Use a competitive analysis that compares features, pricing, and positioning. Then make sure to be specific about what you do better and where competitors fall short. And back it up with data or customer feedback, not just your own opinion. Then, when they ask about defensibility, this is the investor asking about what stops someone from copying you. This could be proprietary technology, patents, or advantages that can't be easily replicated in short order. Because from the investor's perspective, if you can't dominate your market, you can't get the revenue growth that leads to the exit valuation that gets them the return they're looking for. So you need to be able to clearly articulate what your defensible advantage is and why it would be difficult for a well-funded competitor to take your position. Timeless types of defensibility, especially in this age of AI, are distribution, industry experience, and team. Patents aren't recommended for software in the early stages because it just alerts competitors as to how your technology operates, because patents are public filings, so competitors can easily pull up your patent, iterate on it, and overcome the protection. So when I talk about distribution, what I'm talking about is audience and customers. In this age of AI, when anyone can whip up a software easily, software is no longer the moat. The ability to reach, close, and keep customers is the moat. Your customer engine. Once the investor is comfortable with the market, the conversation shifts to your customers. They're going to ask who your ideal customer is, how you acquire customers, and what your churn is. For the ideal customer question, this is the investor checking whether you've narrowed your focus. They want to hear a specific profile, not a vague answer like anyone who needs our product. You should be able to describe your ideal customer's industry, size, pain point, and why your product is the right fit for them specifically. Then, when they ask how you acquire customers, this is the investor evaluating whether you have a scalable process. At the early stages, founder-led sales is expected and actually a good thing because it shows that you understand your customer firsthand. But the investor also wants to see that you're starting to build a repeatable system. That can be an outbound motion, content marketing, partnerships, or paid acquisition. So the way to answer this well is to show that you know your customer acquisition costs, you can explain where your leads come from, and there's a path to scaling it beyond just you personally selling. And then there's the churn question. This is where a lot of these conversations can get interesting. If your customers are leaving at a high rate, nothing else matters because you can't outgrow churn. Investors know that a company with low churn and steady retention is worth significantly more than one that's growing fast but losing customers just as quickly. So you need to know your numbers here and be able to speak to them with conviction. Important metrics in addition to churn are your customer acquisition cost, aka your CAC, or in other words, how much does it cost you to acquire a customer, the lifetime value of your customers, or LTV, which means how much value, aka how much do your customers pay you and over what period of time. If your CAC is lower than your LTV and your LTV to CAC ratio is 3-to-1, then you're in a good place. Churn also ideally should be under 7% annually. The scale story. And the last set of questions is about where your company is headed. They're going to ask what percentage of your business is automated and what your AI plan is, and then also how it scales. For the AI and automation question, this is the investor trying to understand how your business operates today and where it's going. Now, every time period has buzzwords that investors look for. At one point, it was blockchain and tokens. Now it's AI and AI agents. The key to answering the automation and AI question is to make sure that the automation and AI question actually has a meaningful function. When AI was first becoming popular, every company rushed to introduce AI functions and everyone just slapped AI into their pitch decks or their business model, hoping to secure VC. Now, the market has matured at this point beyond that, and in general, following trends for the sake of following trends is not a good approach. Find ways to incorporate automation and AI into your business in meaningful, valuable ways and impress your investor with practicality. And when they ask about scale, what your investor is really asking is if the business can grow revenue significantly without growing costs at the same rate. That goes back to what makes a business VC fundable in the first place. High margins, low marginal cost, and a large addressable market. Your answer should connect your current traction to a credible path. Because from the investor's perspective, they need this investment to return 30x to 100x in 7 to 10 years. So if you can't show them how the business gets big enough to make the math work, the rest of the conversation doesn't matter. The key to the scale story is to demonstrate your knowledge of the industry you're looking to enter. Show the path to scale by laying out how you will follow the beachhead model. The beachhead model is where you start with a small niche, secure that niche beachhead, and then expand beyond that very small beachhead to capture more and more of the market. And the way this happens is by deep knowledge of what's missing in your industry and what the pains of your industry that you're focusing on are. Now, if you're a startup founder who's getting ready to raise, knowing how to answer these questions is very important, but there's another half to make sure you get right. That's making sure your legal documents and company structure can actually back up what you're saying in the room. So if you want to ensure that aspect is fully handled before talking to investors, just click the first link in the description to book a free consultation with me. We'll go through your specific situation and make sure your legal setup is investor ready so nothing comes up during due diligence that slows down or kills your deal entirely. Again, you can book a free consultation with me by clicking the first link below this video. And if you want to learn what a data room is and how to actually build one for when you're raising, then check out this video next.